right, folks, welcome. Thank you. Thank you for coming. It means a lot to us here. And I'd like to start by introducing myself. My name is Greg Freyman. I'm a CPA and a CGMA, and it's my partner, Angela Freyman. She's an enrolled agent with the IRS. Being a CPA means I'm licensed by the state, and I have special powers. No, I'm just kidding. Angie is licensed by the IRS, and it's a federal licensure. We have pretty much the same special powers, which deals with representation, obviously tax preparation, and other fascinating things that deals with tax compliance. All right, so basically we're here today to give you a presentation on, Angie's gonna go over some important due dates that are coming up, and she's also gonna discuss new tax credits and incentives that the government's rolling out into 2023 and beyond. And then I'm going to cover tax deductions, planning, and strategy that is commonly overlooked and can hopefully save somebody here some money. All right, without further ado, my partner, Angela Freyman. Thank you.
Thank you. That's how we roll. Hi guys. So I'm going to talk today about a couple of things like Greg mentioned. I'll talk about the coming up deadlines, and then we'll talk about some tax credits. So the first things that we have on the horizon, the first date is January 17th. It's coming right up, and that's going to be the fourth quarter estimated tax payment for 22. So if you typically owe money with your tax returns, or if you expect that you will owe this year, you should be 90% paid in with your taxes by this deadline for this year. Or if you're not sure how much you'll make this year, we should be 100% or 110% paid in for prior year. So that's where that 117 comes in, coming right up. The next important deadline, and again, I'm only going over some of the basic ones. There's a lot more deadlines out there, but these are something that applies to many people, is the January 31st. And what that is a deadline if you've paid a contractor or landlord. You would owe anything over $600 for the prior year. You would have to issue them a Form 1099 NAC for contractors, 1099 miscellaneous for your landlord. And again, those are due January 31st, so that's coming right up. There's also a W-2 deadline on that same date, but typically if you're on payroll, your payroll provider will take care of that, so there's very little involvement from your end. Now, the next deadline we have is March 15th. That's a big one. If you have a partnership or an S corporation tax return, that's the due date. And another deadline that falls on March 15th is if you're considering to elect an S corporation status for your business or to remove it, that would be the date to do it by for this calendar year for 2023. So the IRS has a deadline for electing the S corp election status. And lastly, April 18th. Typically it's April 15th. Everybody knows that date. This year it falls on the 18th due to holidays and weekends that are falling around that time, and that's going to be your C corp tax deadline, individual deadline, and that also happens to be the estimated tax due date for your first quarter of 2023. So that's as far as the deadlines go. And now I'll go into a slightly more exciting topic of talking about the energy tax credit. And there's a few that are coming out that are new or different than in the past. So basically, the IRS is going to follow with the new Inflation Reduction Act tax credits. And what's happening is we have a, let me write it up, a new electric vehicle credit, and that's going to be $7,500. And what's changed this year for this credit is the manufacturer limits have been eliminated. So that's the big thing, that now you can go ahead and purchase an electric vehicle if it's a new vehicle and it's produced in the US. You now get a $7,500 credit again on any vehicle. So that's one new important credit. So you can go ahead and get that Tesla again. Now there's also a new tax credit for old or used EVs, and that's new. You get up to $4,000. You get up to $4,000 for the used electric vehicle credit. And there are some limitations on your AGI, so you have to make under a certain amount to qualify for that. But it is a nice new credit, so you can purchase a used vehicle, get $4,000 or 30% of the vehicle's cost. So that's another one. A third EV credit is going to be for commercial vehicles. So with commercial vehicles, we got two options. If you're purchasing just a regular business vehicle, you get $7,500 credit for commercial use vehicles. But if you happen to be in the type of business, and I'm not sure if that applies to anybody here, but if you happen to be in the type of business where you have a heavier use vehicles, you can, heavier than your typical pickup truck would be, you get up to $40,000 in tax credit. So it's a much bigger credit. You can get as much as $40,000. You have to criteria to qualify for that, but it's a much bigger tax credit. So that's as far as the electric vehicles go. You get the new vehicle credit, old or used EV credit, and also commercial EV, up to $40,000. I don't know if you guys can make out my handwriting, but I try. So that's as far as the EV credits. There's one more that goes hand in hand with this, and that is setting up the electric vehicle charger in your garage. You now get up to $1,000 tax credit for that. So that's something that's new for this year. It was eliminated in 22, and they brought it back. Yes?
You get it all in the year that you buy? Like if you finance the car for 5 years or something, you get the whole thing?
That's a great question, absolutely. So you get to get the credit now, even though you're financing the vehicle. So, yes. Sure. And so the other credits that the Inflation Reduction Act came up with that are relevant to many people are going to be the energy efficient home credits. And basically what you're getting is there used to be an energy efficiency home credit of up to lifetime $500 credit. So if people replaced windows or put in solar or something like that, they would get $500 once, and that was it. So that's been extended and improved, and now you get a $1,200 annual credit. So every year you can get up to $1,200 on qualified energy efficiency improvements, such as new HVAC, efficient windows, doors, things like that. They also throw in a $150 credit towards that maximum for doing an energy efficiency audit of your home. So there's a whole slew of items now, and I've listed them out in your handout, that basically go through all the different credits, all the different improvements that you can add to your home to qualify for that credit. And one other thing is, though, even though it's a $1,200 per year credit, if you put in a new heat pump or water heater, you get a $2,000 credit for that. So a little bit more. Now that's as far as the homes go. And there's also a credit for new energy efficiency homes. So that's if you're in the market for purchasing a brand new construction home, you can get credits. They go up to $5,000 depending on what is included in that new home. So that's also something new for new construction homes. And lastly, what I wanted to mention is, since we're all business owners here, there's an expanded research tax credit. So that's a credit that was already available to business owners before, but if you're spending any of your company time on R&D, you can claim up to $500,000 now in tax credits towards that research and development. And the way that you get that is through payroll liability credits. So when you're filing your payroll filings, your FICA taxes get offset with this credit. So you have a much larger limitation now that you can take advantage of. And that's kind of the summary of the new energy efficiency tax credits that I have for you, and I'll turn it over to Greg, who will discuss tax saving strategies and deductions.
Yes. Thank you very much. That was awesome. As you know, the government's always trying to stimulate one thing or another using tax law. So if you'll excuse me for 1 second, please. All right, guys. So what were we going to go through with you guys today? Well, I like to kick everything off always with a couple of questions. And anybody else here have a bad hair day besides me? No? Nobody else. All right. Second question. What does CPA stand for? Wrong. Cheapest person alive. So today I'm going to help you save money. All right, third question, and this one I expect you guys to know. All right, as business owners, what is the definition of a tax deduction? Anybody? Are we all business owners? Are we all claiming deductions? Well, what's the basic definition? Ordinary and necessary. So in other words, the IRS defines a tax deduction that has to be fit into an ordinary and necessary part of your dealings. So in other words, if I'm driving a truck, it's ordinarily in the course of business for me to drive this truck because that's what others do. It doesn't mean I can't fly to make the deliveries. That would be necessary, right, to make the deliveries happen. So that's the basic definition of tax deduction. All right, how does that intertwine with tax planning and strategy? Well, it's a really great question, because tax planning, strategy, and tax deductions are all intertwined, which means you kind of work together to get it all done. And more importantly, it's important to understand that tax planning is very different from tax preparation. So tax preparation is basically getting information into a tax return and telling a story of what already transpired. So all planning opportunities at that point in time are already done. And now we're just dealing with what we call after the fact. And after the fact, it's done, and most of the time there's no more opportunity for saving money. Therefore, what do we want to learn? We want to learn what is the definition of tax planning and what is the definition of tax strategy. All right, so tax planning tends to mean that we're either accelerating or decelerating something. And usually that something is income or deduction. Okay? So yes, we can accelerate the income. Yes, we can decelerate it. Yes, we can accelerate our deductions. Yes, we can decelerate them. In other words, slow them down. Now, tax strategy kind of comes into play when we're going to take this and make it happen to fit a certain situation or criteria that the IRS allows for us to get the most out of the system. That's what we're all trying to do. We're trying to make sure that we're getting the most out of the tax system, because our tax system is a snooze you lose type of system, right? So if you don't take the right opportunity, you're going to lose out, and the tax man wins. So that's our job, is to ensure that our clients get the most out of the tax system legally possible. At the same time, we have to ensure that the IRS is getting their, or the state is getting their fair share as well. So it's a very complicated situation to be in, and we often refer to it as being the monkey in the middle. All right, is everybody clear on planning, strategy, and deductions? Everybody? Awesome. Awesome. All right. So now that we have that, so over the years, I've definitely spent a lot of time looking into tax strategies and tax planning, and it saved our clients quite a bit of money. Now, one of my favorite clients of all time, she's so near and dear to us that she insists that we call her Auntie. And she's actually a CFP, a Certified Financial Planner. And basically, she's quite well versed in the world of finance and cost savings and everything. And she once told me, once we had a discussion on tax planning, Greg, we don't want to make the tax tail wag the dog. And I said, that's the best expression I've ever heard. Because it's so true. We don't do things in the world of tax planning and strategy to save money in tax as a primary motivator. Our primary motivators typically tend to be financial reasons, perhaps religious reasons, and if they fit for tax reasons, then great, then we should do it. But we're not going to spend $1 to save 30 cents because that's what a deduction really is, right? We're going to go out, we're going to buy something for $1 and it might save us 30 cents in tax. So that cannot be our primary motivator, correct? Would you agree? Awesome. Awesome. All right. So we went over our favorite quote. Now let's just dive right in. And if you guys have your handouts handy, I'm going to go through these one at a time, and then we can go through Q&A. Now, you might have heard some of these in the past. If you're a business owner, you might not realize that some of these can be manipulated to your benefit. And if you have questions, like I mentioned, we'll go through the Q&A. So, number one would be setting up a home office, and then your commute to and from work would become deductible. So traditionally, in 90% of the cases, getting from your home over here to Atlanta Tech Park would not be deductible because it is considered commuting, and the IRS specifically says no. But there are exceptions to every rule, and then there's exceptions to those exceptions. Wearing jeans or not, it doesn't matter. We want to find that exception to the exception, and that exception in our case would be having a qualified home office at home, which many people actually do. And the IRS says that if you do not have a space, as in here, where it's virtual for us, we don't actually have like a physical space, we have to do all of our work at home. Or for some, it could be a store or a restaurant or own, and they cannot do the administrative and managerial functions there because it's just not really set up for it. So they come home and they have a qualified space, a qualified home office space, where they do all their administrative and managerial tasks. That can include accounting, calendar, contacting business associates, what have you. All of a sudden, that qualified home office opens up a brand new deduction, and that deduction will be coming to and from work. Because that took something that ordinarily is not deductible and just made it deductible. Okay, so that's a great example of planning and strategy to get to a deduction where there was none. All right, so that's a very common tactic, and it's very commonly overlooked, believe it or not. Make sure that all of our clients get that if they qualify for it, and we put it through the payroll. Next down the list, guys, meals. Meals has traditionally been 50% deductible. Now, came out the TCJA of 2018, and they said no more. They said basically now, I'm sorry, let me just go back. So COVID happened, and during COVID, not the TCJA, I'm gonna correct myself. Due to COVID in 2020, a lot of the restaurant industry suffered greatly. So the government, again, steps in to help the industry and said, okay, well, you know, we know that this industry is suffering. We're now going to introduce the meals to be 100% deductible if it fits into this criteria. And that criteria is the food has to be immediately ready for consumption. So in other words, if you stop at a Starbucks and you're buying yourself something that's immediately used for consumption, it's 100% deductible for 2020 and 2021, and I believe 2022. So that's great incentive, because now where it used to be 50% deductible traditionally, all of a sudden you're getting 100%. And again, it's just the government's way of stimulating that industry. 2023, they revert the law back to 50%. So now, instead of getting 100% for that business meal, it goes back to 50%. Now, I've done a lot of tax returns in my life. You would not imagine how many times I've seen other accountants work, and I'm not bashing other accountants. You know, it's just all plopped into 50% deductible. But there was always the opportunity before this change in law to take 100% of the meal. And it just has to fit in different category. Change the stripes of a zebra, but we can look for the opportunities where the code allows for it. Okay, and that could be expenses for meals like holiday parties, pantry expense, advertising food. Something of this sort would fit into 100% deductible. And all of a sudden, instead of missing out on 50% of that deduction, we're getting 100%. All right, retirement savings is our next bullet point, guys. Now, once upon a time, I had one of my clients come to us, and she was very driven to contribute as much as she could to her retirement account. Unfortunately, not everybody can max out their retirement account because one might be eligible to put in as much as $58,000 in 1 year into a SEP IRA. But here's the problem, you just might not have it lying around. So what do we do? We go strategically on an extension. This again, everything I'm saying here applies to very specific situations. Always check with your tax advisor. This is not formal tax advice. I just want to make that clear because not everybody will qualify for this specific strategy. But again, we're talking about very commonly overlooked opportunities, right? So in this particular case, if you go strategically on an extension, you have until October 15th of the following year to make a contribution for the prior year, get the deduction on your, so if we're in 2023 and we're filing 2022 taxes, I have until October 15th to really put in a big chunk of change into my SEP IRA. And all of a sudden, instead of taking $10,000 and putting it into my SEP IRA, I could have had an opportunity to save an extra 10 and max out to my fullest potential given my specific situation. So that's a very commonly overlooked one, and I think it's a great strategy for those that are motivated to put away as much as they can towards retirement. In fact, I definitely need to take my own advice on that one. So, all right guys, next one on the list is really kind of overlooked, but not really. Health insurance, H.S.As, and L.T.Cs. All right, health insurance premiums, health savings accounts, and long-term care. If you're in your 40s, you probably need to start thinking about long-term care. This is the time when it's the most beneficial for us to open one of these plans up and start saving for the future for medical costs. Okay, the same goes with H.S.A. It works much like an IRA where we're contributing money into a medical account and we're saving money and then we're using it and creating a deduction where there was none. The same thing with the health insurance. They're all treated the same for tax purposes. That's why they're all in conjunction next to each other. And I like to put them there because even though people put their health insurance through their business and receive that perk, they often do not consider long-term care and they often forget about their health savings account. It can benefit many people. All right, if it's an S-corp situation or a partnership situation or an individual business situation, it is still going to be treated the same way for tax purposes in most cases. All right, next one on our list is the H.R.A. or health reimbursement account under Section 105 of the Internal Revenue Code. What does this mean? Well, a health reimbursement account is something that where we just reimburse an employee for their medical costs. Really only kind of fits well into situations that come to mind. One is a C Corp, which most people here probably do not do business under, so it won't really apply to most here. But where it would apply is where a situation very strategically done, where you have, for example, a single member LLC owner, right, a sole proprietor, if you will, and he has a spouse that's working in the business. The spouse does not actually have any ownership in this LLC. It is just a worker. And taking that into account, the strategy would be is to reimburse your spouse for medical costs, whether that be out of pocket, whether that be health insurance, long-term care, what have you, and not furnishing a W-2 for that. And all of a sudden, I get a deduction out of the blue using strategy. All right, there would be no W-2 requirement, but this still has to be a worker. This is not just a kind of working situation. This person should really be working and you should really be documenting it with a timesheet or what have you. So it's a great way to get that money out of that business, reimburse your spouse for all the medical costs that can cover her, the kids, whoever, and get the write-off, creating a paper trail. All right, again, that has to be under a Section 105 plan that is set up. It's not just done nilly-willy. There are some formalities and some paperwork that should be put into place. It's not exactly complicated to do. All right, next one down the list, guys. I'm gonna go a little bit quicker just to make sure we make good time. Out-of-pocket costs. I mean, this one's kind of like applies to many people, but probably quite overlooked, and we see that in practice to us, and they just started their operations and they had a lot of out-of-pocket costs to get their business going, These could be equipment purchases, formational costs, travel, all sorts of things that everybody has to go through in order to start up this business. So this business hasn't even been born yet, but you've already incurred a bunch of expenses and they can often be overlooked. All right, I'm going to touch upon a couple of personal tax deductions and strategies that are overlooked, just to throw that in there, but most of these will apply to businesses. All right, sales tax as an itemized deduction. In states where there is no income tax, like Florida or Texas or Tennessee, we see that a lot. We see where people often forget to include sales tax as an itemized deduction on their Schedule A of their 1040 return. All right, what does that mean? Well, that means that you have the choice to take either state income tax on your Schedule A as an itemized deduction or the sales tax as an itemized deduction. Where most people trip up is where they don't claim large purchases. So if you go out and any day now and buy yourself a car and you're going to spend $3,000 on the sales tax because of the price of the vehicle, or it could be a boat, or it could be furniture that you're doing, all of a sudden that amount of sales tax becomes deductible on top of the standard sales tax. So it can actually stand to save people quite a bit of chunk of change just knowing that that's open. So that's a question we always ask our clients, and it does apply to states where there is income tax as well, like Georgia, but it's not often. But there are definitely situations where it would apply. All right, guys, moving right along. Unreimbursed partner expenses is really a great one. And unreimbursed partner expenses is just exactly what it sounds like. If you're a partner in a partnership and you incur expenses that went unreimbursed, and these could be your personal expenses, such as driving your personal vehicle, using your cell phone, working from your home office, what have you, you're entitled to claim that against the income that's passing through to you from your partnership, or you are a partner. All right, here's the trick though, okay? You need to have special provisions within the partnership agreement for it to qualify. Otherwise, it can be easily audited. You would not believe how many times I've seen this declaration missed on people's tax returns that are eligible for this deduction. And all it really needs is a partnership agreement, and it needs the provisional wording in that partnership agreement in order to claim the deduction and do it properly. All right, folks. Next one is really near and dear to me. We see that a lot. Claiming a parent, a boyfriend, a girlfriend. No pets, guys. No pets. Sorry. Yeah, I know. Fido. Yikes. Service dogs would be medical, sir. We're talking dependency. Great question. Let's save it for the Q&A. All right. Yep. As long as that individual qualifies, we can definitely grab them as a dependent. Now, the parent doesn't actually have to live with you where the boyfriend or girlfriend does. That's the one big distinction. All right. Yes. So you're a parent if they're elderly and they're living apart from you and you're providing more than half of their support. The living in your place of residence is not a criteria. That's the exception to the rule. The next one is definitely, oh, and by the way, that was a personal deduction, okay, obvious. Now, the next one is a big one. This is a big one. This is where I've seen people really save a ton of money in taxation, but it's a double-edged sword because it can actually come back and bite someone in the rear. We don't want that to happen. So switching accounting methods. Anybody here familiar with accounting methods? Raise your hand. Oh, sorry. Please. Plus, minus? Okay, so we really have we have hybrid, but in reality, we got basically two tables to choose from, right? We got the cash table and we got the accrual method of accounting. If anybody here took an accounting class way back when, the cash basis of accounting is what most people tend to be under. And that just really means that when I incur the expense or when I actually pay for that expense or when I receive the income, right? That's when I'm going to record it. That's when I'm going to pay taxes or receive the deduction on that. Okay? Very different from the accrual method of accounting, which is what I call the true accounting, because cash basis was really invented by the IRS to make taxes simpler. And the accrual method of accounting is really true accounting, because in the real world, we want to know how we're doing from a financial perspective in real time, not when we pay for it, right? So if I get an order that's coming in right now for my business and I'm looking at the invoice, I'm like, man, I owe them how much? yeah, I owe them now and everything's been delivered or services have been rendered, even though I haven't laid out any money yet, and I might not lay it out for another couple of weeks and sometimes a month, I've already incurred this expense. So I have to record it in my books, and I have to already receive the deduction. Okay, and that's really true accounting because we're showing what's actually happening. And that's the accrual method of accounting. It's income that's accrued or expenses that are accrued. So what happens if we switch from one to the other? It can actually stand to save somebody a lot of money, because all of a sudden I could be pushing in a bunch of expenses into the prior year where they belong. It's not easy to do. We have to get specific approval from the IRS to do this. So once we make this election, it's kind of done. And then we have to request a revocation of this election. No fun. And if anybody works here with the IRS and understands what COVID did to the IRS, you'd understand how complicated pushing anything through is now. So we want to be very careful when we're making huge elections like this. These elections are done, unfortunately, many a time without the client ever being the wiser. I always have this conversation with a brand new client. Hey, we're going to make you a cash-based taxpayer, and we're going to elect it on your first return. And that's really the only time we get to do it without a whole bunch of hoopla and any special permission from the IRS. So once that's done, it really cannot be easily undone, and vice versa. That's why I'm saying when you do something like this, it is definitely a conversation to be had first with the accountant, because certain industries should be in the accrual basis and certain industries should not. It all depends on facts and circumstances, always. So if an accountant has elected this for you without even having this conversation, it's already something to be wary of. All right, and to my point, once this is done, we're looking at a snapshot in time. So if it works for you this year and we move in all those expenses and all of a sudden you're $20,000 richer because you didn't have to spend that money in tax, but what happens next year? So we're always looking at the outlook of the client, and we want to look forward, and only the client can really bring this to light. I don't know the dealings and the details of my client's business as they do, because I'm not involved to that nature. But my job is more to have that insight and say, hey guys, you know, it might work for you this year, but what's going to happen the year after and the year after and the year after? Is it going to come back to bite you in the butt? All right, brings me to depreciation tactics. Ready for war? Who here is ready for war? Everybody. All right, well, with depreciation, I like to think about it as cost recovery. You know, you've all heard of this. You buy a truck, you drive it off the lot, the thing plummets. Well, that's a depreciated asset. That's something that depreciates quickly. What about real estate? Real estate goes up in value, depreciates. What is depreciation altogether? Anybody know? It's really when something goes down in value and we get to elect how quickly we can declare that on our tax return. We could either write it all off, or we can spread it out over the prescribed amount of time, 5 years, 7 years, 27 and a half, 39, 40, whatever. All right? But now we're playing with these numbers. And if something happens to that asset down the road, aka you sell it, aka you trade it in, what have you, now we're going to touch base with the IRS and say, well, I completely wrote off this truck. It's like now zero in my hands as a taxpayer. But now we have to square up, because in reality, I received value for this vehicle when I sold it. And it actually, you know, I got $20,000 for it. So guess what? It didn't really depreciate that fast, did it? It actually has value. It's still worth $20,000. So whoops, I owe tax because I wrote it off. And it was worth zero in my hands because I fully depreciated. I was aggressive with my deductions. This is another conversation that every single client should have with their accountant, and I've seen it time and time again. People came to us, oh my God, my truck was depreciated over the prescribed 5 years. I wanted to Section 179. I wanted to bonus that and get it all written off immediately. So again, another great topic to have whenever you're buying any assets. It could be software, it could be your truck, anything. This is all conversations you should have with your tax professional and understand what you're really doing with this asset. And again, it'll come down to your outlook, to your specific situation and your specific tax situation rather. Okay? Now, when we're thinking of depreciation, just remember this, guys. I don't expect anybody to really understand it, but we're dealing with more tax now versus less tax later. As in my example, if I write off this vehicle to zero, 3 years from now, I sell it. All of a sudden, I'm getting value for it. All of a sudden, I have tax. So I just created no tax then and more tax in the future where it might not actually prove to be beneficial to me because of change of rates or what have you. All right, guys. That almost concludes the presentation. I did want to throw in one more thing, which is a very, it's kind of like they say, you know, common knowledge is not so common. And every single client that's ever walked in my door, our door, usually will ask, hey, I'm starting a business, LLC, C Corp, or S Corp, which one should I go with, Greg? So it's a very common question, but I just wanted to throw that out there. Yes, entity type formation or election is definitely something that can save somebody a lot of money. And something like a C Corp is never a great way to go for tax purposes, right? Everybody knows that. Nobody here, I bet you, is doing business under a C Corp. It would probably be rare. There's definitely instances where that's done, but most 90% of small business out there are either an S Corp or an LLC. But believe it or not, there are some very specific strategic positioning that can be applied for C Corp for your small business. And again, these are all conversations to be had at the right time. And again, whenever you're sitting down with your tax professional and you're like, I want to become an S Corp, I heard it saves me money. Well, yeah, we can do a snapshot and we could say this year it'll save you money, but what happens the year after and the year after? So in my experience, sometimes it might not prove to help in the future because of the unpredictability of business. All right, guys, that concludes my presentation. I hope it was informative. I hope you guys liked it. I'd like to extend now our Q&A for everybody. I'm sure everybody has a lot of questions lined up for Angie. Take it away. No? All right. Good time, too. We got 15 minutes.
And we'll try and answer it.
We don't bite, really. Just ask anything. We can answer it, for sure.
Go ahead.
So, from an equipment standpoint, you talked about a vehicle. That's an automatic $40,000.
No, sir, that usually applies to like large,
I understand that, yeah.
Yeah.
I mean,
like those
6,000
semis.
pounds, something like that.
Yeah, big.
Okay, so as far as something else, like we have to buy a large boat to use for for filming for a big project we've got coming up. Is that a depreciable asset that we can depreciate?
Is it ordinary necessary in your line of work, sir?
Absolutely, yeah.
You just answered your question, sir.
Okay.
As long as we're fitting that into the ordinary necessary, we can use a jet plane and a rocket ship. You understand? It has to be in the ordinary course of business.
So I can buy a jet and be ordinary.
As long as that's normally in your course of business and you're using it for business purposes and not for personal reasons, yes.
Yeah.
Absolutely, it would be deductible.
Okay, so where does that fine line come between personal and?
Great question. Great question. If it's being used for personal reasons, in other words, your motivation has to be personal in nature. So many people own a jet plane and they fly from place to place for business, and sometimes they might use it for personal reasons. That doesn't disqualify the whole deduction, the whole jet plane. It's just the percent now can no longer be used. Commonly seen with personal use vehicles. So you own the vehicle, right? You drive to and from work, or maybe you go see clients, what have you, depends on what you do for a living, right? So part of this is going to definitely be personal use, and part of it is definitely going to be business use. So we're just going to take that business part and use it. And we're definitely going to use it. Yep.
And we often see that with boats also, where a client will have a boat for their client to use, but then there's also a personal portion of that.
Right.
And it's just getting split up.
Out every time I want to use it.
No.
And you're talking about taking out a part of that personal, is that just, let's say, I fly a jet and 1 month out of the year it's personal. Does that just mean you're taking off that, whatever, 10% or 12%?
You want to go with it?
Or
Yeah.
would that still be considered a business?
So generally, you would just prorate the business portion versus personal, and if 11 months out of 12 you're using it for business, then that's going to be the deduction that you get, is that portion. But it needs to be an ordinary necessary business expense, not excessive. So If you're flying to see clients, it's one thing, but if you're, you can't just make up a reason to get a business deduction.
Yeah, and there is that fine line. Absolutely. I mean, it is hard to say what's the motivation, but if it is in true fact a business reason, it's always good to document your reasoning. And there's a great rule that we think of. It's called the Augusta rule. I mean, everybody here has heard of the Augusta rule, right? Come on, everybody here is from Georgia. Anybody heard of Augusta? Golf? Nobody. You want to go over this?
You go ahead.
No, you go ahead. Come on.
All right, so yes, so the Augusta rule started out in Augusta, Georgia, with the golfing community, but it definitely applies to everyday situations, and that basically states that you can rent out a personal residence of yours to your business for up to 2 weeks and not have to declare it on your tax return. So a lot of tax strategies are based on that, where any residence that you have that you're renting out, you're taking that, you're not converting it to a rental use. But for example, what we commonly see is if your business needs to have a nice place for its annual shareholder meeting, and that's where you're meeting with your partners or shareholders to discuss whatever it is that you guys work on, you can rent out your residence to your business as long as it's under 2 weeks. So maybe you have a retreat at your house, you have a nice house. That's going to be basically a business deduction to your business, but you're not filing scheduling, you're not reporting that as rental income. So it's just kind of a free deduction.
You mean we just got a deduction and we didn't have to report income?
Correct.
Wow, that's strategies there. But to your point, sir, to your point, it still has to be fully documented. And there's very specific protocols as to how you do document this whole 14-day hiatus to get this special treatment, because if you're ever audited, what's going to happen? You're going to have to prove it. In our world, folks, it's not like the legal system. It's not you're innocent until you're proven guilty. In the tax world, you're actually guilty by default, and you have to always prove your innocence. So everything we always do is basically tax proofing. Audit proofing, because we're always under the assumption that we're guilty. It's awful. It's like having a Jewish mother walk around with you all the time. I'm Jewish, so I can joke like that. Go ahead.
Yes, and the only other similar situation that I wanted to bring up is there's where you can say you're a real estate investor and you're renting out your property. It was the 2-week rule I told you about.
Oh gosh, my memory's
You can stay at each of your properties for 2 weeks and it still will be considered not a vacation property. So let's say you bought vacation properties all over the country. You have 25 vacation homes.
That's right.
You can stay at each one of your homes for basically for 2 weeks, and that will not be considered your personal use residence. So you still get to deduct the full amount of your rental properties when you're living for free all over the country. It's a little bit far-fetched, but some people, I'm sure, have done that.
And so it'll definitely meet somebody's criteria.
Yeah.
Again, taxes and deductions is kind of like shoes. Nobody really has the same pair. So that's why it's so important to discuss all these things with somebody that's knowledgeable when it comes to tax planning. Yes, sir. You again.
Don't call me sir, I work for a living.
Gotcha. I'm sorry, what's your name?
So, IRS question
For lady.
for the lady, yes.
You got it?
So, when the Fair Tax Act gets approved this year, how is that going to affect business?
Not familiar with that.
Fair Tax Act.
Fair Tax Act.
Well, in
What are
other
the
words,
details?
There's going to be no need for the IRS, it'll be gone.
Uh-huh.
Everything will be consumption tax.
Like sales tax.
Basically, yes. Like the VAT in Europe or whatever.
Yeah.
Well, I guess we'll be flipping burgers.
You'll be flipping burgers, okay.
We'll
Good
have
luck
to
with
find
that,
something
yeah.
else to do, but I don't think that will actually happen.
Yeah.
There's always been
Well, I
talk
hope
about
so.
that,
I
and
mean,
it would benefit some, but I think majority of people won't benefit from that because now you're paying just the sales tax. So unless you're in that top 1%, you'll be paying more in taxes generally than
we'll see.
percentage the same, but in dollar amounts it won't be.
We'll see.
Yeah.
Beneficial,
I don't think
yeah.
that would be very fair. I don't want to pay the same amount as everybody else.
All those wonderful tax deductions will go away.
So just taking what you were just talking about back a bit. So I don't say I don't have rental properties under myself, but we do have to have that yearly meeting somewhere. That still is a full write-off of that, or does it have to be a property that you own?
No, so you don't need to have a rental property. If you choose to hold your meeting at your place where you reside, you can, as long as you document everything correctly, you can rent out your home at fair market value for that period. So you would just need to know how much it would cost you. You can look up at VRBO or Airbnb how much is a home similar to mine in this area, and you can rent it out to your business. And as long as it's under the total number of days you've rented out your home is less than 14, you follow the Augusta rule. And basically, it's a business deduction. You record it on your business books. But when you file your personal tax return, you do not record it as income to you. So yes, you don't need to have a rental for that.
Yes.
All right, I have a question about the electric vehicle credits. It comes from federal, right? So I that Georgia State has similar or same credit.
I'm sorry, I didn't hear.
If Georgia has a similar
Yeah,
deduction,
I would have to look that up. I have not heard of a Georgia tax credit for the vehicles. So unless it's something new. And that's something I'm more than happy. We'll take down all your contact information. I can look up and get back to you.
I believe Georgia credit is dissolved a couple years ago. But we only get federal credit.
Gotcha. Yeah. It's one of those things that can also change every year. So I haven't heard of that being for this year. Just the federal.
Does the EV credit only apply to certain models made in USA?
So the models have to be made in the USA. That's a new thing that came out since August, and I think it started as of October. You had to comply with that. There's a website you can go on that will actually list out all the eligible vehicles. So you can look that up and see if the specific model was made in the US. But the manufacturer limits have been phased out. So Tesla and a few other vehicles, I don't recall, I think it was the Chevrolet maybe, that basically have already been phased out fully or partially. Now that no longer applies. So as of 23, everybody gets that credit. For the new vehicles, it's $7,500 per vehicle as long as it's made in the US. For the used vehicles, there's different limitations. You can only buy one vehicle every 3 years. So you can't do it every year, and it has to be for personal use. There's other requirements. For example, the person getting the credit cannot be a dependent on a tax return, and there's income limitations. And the income limitations for new vehicles is double that of income limitation for used vehicles. So there are specific requirements, but pretty much every vehicle that's made in the US that's electric and qualifies from that website, that will be the credit now.
well, you really know your stuff, Angie.
I stay up to date.
Round of applause for Angie. That is well said. Well said. Thank you,
Thank
sweetheart.
you.
I know I married you. What else do you guys got? Come on. Got 5 minutes, folks. Be here all day.
So the long-term care, so how does,
Yes.
can you talk a little bit more about it?
Absolutely, absolutely. Glad to. In general, like I mentioned, the health insurance, the long-term care insurance premiums, they're treated pretty much the same for tax purposes, and they're treated as deemed compensation if we're dealing with an S corp, or if we're dealing with a partnership, or if we're dealing with a sole proprietor. And what ends up happening is basically you're deducting it from gross income. It's just how it's represented might slightly change. In other words, if I have an S corporation, these two items would have to be reported on my W-2 to receive the deduction properly. If I'm a sole proprietor, I can just pay it with my own personal funds. There's obviously no W-2 or anything like that, and I still receive the deduction. But it's treated exactly the same way, and as well as the H.S.A. contributions.
Okay.
Yep.
So for an LLC.
Yep. Yeah, for a C corp, it wouldn't apply. The C corporation, again, is a rare form of entity type formation because usually most businesses tend not to fall under that.
So we're an LLC, so premiums or H.S.A. contributions
question with a question, but that's the world we live in, right? Everything depends in our world. And if you're saying you're an LLC, now my question to you is, are you being taxed as an S corp or are you being taxed as an LLC? Because there's a difference. It is being taxed. So in other words, you're filing a partnership return. Right. Yeah. So that would be very much like a guarantee. So again, it's treated basically like deemed compensation. It's just reported slightly differently, and it does not have to go through a W-2. Yep. Anything else, folks? Lots of smiles. Lots of smiles. Everybody having fun today with lunch and learn? You learning? Yeah. How was the lunch?
Based here?
We are based here. That's
In Atlanta or here at the park?
Here at the park. Correct. Correct. We have an office in Jacksonville where we're from as well. Kind of doing the reverse snowbird thing now.
Mm-hmm.
You know, getting on in age.
Yeah, you look so old.
Thank you. I appreciate that. I've had to suck a lot of blood for that. No, I'm just kidding.
No, you're 30 yet, are you?
Ah, God bless you. God bless you. I love that. Kind person. Guys, 2 minutes.
Any last
2
minute
minutes.
questions?
Any other of these tactics anybody want to explore with me? Cash rule, out of pocket. H.R.A. is a good one. I personally like that. Overlooked. The home office, I bet nobody here used that one, huh? Driving to and from work, anybody? Do you guys drive to and from work now? By show of hands, who drives to and from home?
Home
You
office
guys
deduction.
commute, right? Are you taking that as a deduction? Be honest with me. I'm not going to tell the IRS. Or Georgia.
But that's a full deduction every time, right?
Sorry, say it again, sir?
A full deduction every time.
It is and it isn't. So in other words, if you qualify, and I'm not sure if you came in when I went over that specific rule, no? So I'll just recap. Basically, if you have a qualified home office at home, like many people do, and they have no other place of business where they can do their administrative and managerial tasks, then that commute to and from the home and back, when it's typically not deductible, becomes deductible. And how do we get that deduction? Is by one of two methods. We either take a standard cents per mile, which is, let's say, 57 cents per mile, or we take the actual expenses, which is very cumbersome. We typically don't advise unless you're using your vehicle a lot for business.
Okay.
So yeah, you can basically put through an extra $3,000 worth of deduction a year, really, depending on how far your commute is. But even $3,000 in deduction is good if you're in the 22% bracket and another maybe 6% with Georgia. 28% of that $3,000 you just saved in tax. And I'm awful with math. So can somebody help me out how much that would actually amount to?
1,000?
900?
About 1,000?
About $1,000 in savings. Boom. You're welcome. Anything else, guys? That concludes the presentation. It is
Right on
1 o'clock
time.
sharp. Well, guys, thank you so much for coming. I really appreciate each and every single one of you. You made my day great. Thank you again. It was lovely speaking in front of you.
Thank you.
You're welcome.